All right, let's dive right into this explainer and learn how to capture those massive, explosive market moves without falling into the classic traps. Today, we're dissecting the exact mechanics of trading breakouts on highly volatile assets, specifically Bitcoin and gold. But more importantly, we're going to talk about how to stop blindly handing your money over to the institutions. We'll break down the charts, the candles, and the pure psychology behind these massive market shifts.
So, we've all been there, right? You see this massive green candle just surging upward, violently breaking through a key resistance level. You get that sudden rush of adrenaline, the FOMO completely kicks in, and you just hit buy. But the absolute second you do, you watch it instantly reverse and trigger your stop loss. You're trapped. Why does that happen so often? Well, it's because institutional algorithms are out there actively hunting for your retail liquidity. So let's look at how to stop taking the bait and position yourself on the winning side of the trade instead.
Here's our roadmap for today. We're covering the breakout phenomenon, real versus fake breakouts, the step-by-step setup, timing and volatility, and finally, risk and psychology.
Section 1. The Breakout Phenomenon.
Okay, so breakout trading at its core is an objective strategy that targets areas where volatility naturally expands. But what does that actually mean in plain English? Essentially, you're not trying to guess where the market is going to go next in a vacuum. Instead, you're patiently waiting for the price to exit a really tight period of consolidation, and then you're just riding the massive wave of momentum that bursts out of it. It's really about letting the market make the first move and then jumping on board once that strength is totally undeniable. I love this analogy. Think of price bouncing tightly between a floor and a ceiling exactly like a Coke bottle. Every single time it hits support and bounces back up to resistance, it's accumulating orders. It's literally building up energy, just like vigorously shaking up a carbonated bottle. Traders are putting their stops above and below these boundaries. And when the price finally escapes that range, the cap blows off, and the release of all those stored up orders is incredibly powerful.
To put that into perspective, we recently saw gold gap up a staggering 250 pips right at the open. That is a massive portfolio-making move. For some quick context, a pip is a standard unit of price movement, and a 250 pip jump can represent an enormous percentage gain on a single trade. It perfectly proves the raw power of that built-up pressure after a slow, range-bound period. When the market finally decides to break out, that sheer momentum can carry it incredibly far in just a matter of hours.
Section 2. Real breakouts versus fakeouts.
Now we have to talk about the villain of our story, the fakeout.
A fake breakout is characterized by a long wick rejection followed by an immediate reversal. Visually, it's like a thin line poking above the resistance level, but the thick body of the candle closes right back down inside the range. It's designed specifically to trigger the stops of early buyers and sweep up their liquidity. A real breakout, on the other hand, gives you a strong body closure that firmly holds outside that boundary, and crucially, it leaves behind a clear fair value gap. That just means there's a serious imbalance in buying and selling, proving genuine institutional volume is pushing the move.
Let's look at a very specific real-world trap. In a recent Bitcoin setup, the price pushed to exactly $77,612, literally just to create a fake, enticing buying candle. This was engineered completely to trap eager buyers who thought the major breakout to new highs was finally happening. The absolute moment they jumped in and placed their buy orders, a sharp reversal was triggered that swept right down through their stop losses. This is the exact liquidity trap we're going to learn to avoid today.
Section 3. The step-by-step setup.
All right, here is your tactical blueprint. By following this strict chronological life cycle, you actually force yourself to wait for confirmation instead of just reacting to your emotions. First step, identify your range by finding two distinct touches on support and resistance. Second, mark the liquidity pools just outside those levels, because that's where everyone's stop losses are sitting and that's where the traps are. Third, wait for a definitive candle body to break and actually hold outside that range. Fourth, look for an imbalance confirmation, that fair value gap we just talked about. And finally, step 5, you enter safely on a 50% retracement of that confirmation candle.
I really want you to remember these 3 words: break, hold, imbalance. Just repeat this mantra every single time you look at a chart. If the price breaks but doesn't hold, or if it holds but shows no strong volume imbalance, you stay completely out of the market. Waiting for all 3 elements of this sequence is the absolute non-negotiable rule that will consistently save your capital from those institutional traps.
Section 4. Timing and Volatility Expansion. So, timing is quite literally everything. The Asian session is notorious for ranging and consolidation. It's building up that Coke bottle pressure. The London session, then, famously, comes in and sweeps the liquidity built up in Asia, specifically hunting the highs and lows to shake out all those early retail traders. And this deliberate manipulation, it sets the absolute perfect stage for the New York session to step in and deliver a massive, true breakout continuation. By marking specific time-based opening lines on your chart, so 1700 EST for the daily open, midnight EST, and 0730 EST for the New York refinement, you create a really strict mechanical bias. If the price is trading above these key opening levels, you are only looking for buy setups. If it's trading below, you only look for sells. It just completely removes the guesswork, ensuring you're trading in alignment with the day's true institutional momentum.
Section 5. Risk Management and Psychology. Okay, these are the non-negotiable rules prop firm traders use to survive volatile markets. Seriously, don't ignore these. Strictly risk only 0.5% to 1% of your total account per trade. Always place your stop loss inside the original consolidation range to protect against those sweeps. If the price snaps back into the box, kill the trade immediately. Do not hold on hoping it's going to magically turn around. Counterintuitively, you should actually size down your risk after a win to protect your fresh profits. And finally, stop trading completely if you hit a negative 3R daily loss, meaning you've lost 3 times your initial risk amount for the day. Doing this ensures a fake out never blows your account.
Advanced algorithmic trading bots approach risk using a concept called equity isolation. If an algorithm is running multiple strategies and strategy 1 is crushing it and growing, it dynamically allocates more capital there. But if strategy 2 is losing, it mechanically halts it at a strict 15% drawdown limit without blowing up the rest of the overall portfolio. As human traders, we have to adopt this exact same ruthless mechanical protection. We have to cut off strategies or specific asset pairs that are just bleeding our accounts in unfavorable market conditions. Ultimately, the difference between losing money and making it all comes down to discipline. Discipline will always be greater than FOMO. When you see a massive green or red candle breaking out, your biological instinct is to jump in instantly, right? You want to catch the whole move. But the historical data shows us, time and time again, that waiting for the pullback, waiting for that 50% retest of the confirmation candle is where your true, lasting edge lies. So, I'll leave you with this question to think about for your own trading style. Do you prefer the thrill of an aggressive breakout entry or the mathematical safety of waiting for the retest? It's something every trader has to decide for themselves based on their own risk tolerance. Thanks so much for joining this explainer, and hey, stay disciplined out there.